The current earnings season has once again ramped up investor worries around AI. Multiple tech firms have announced huge AI spending plans, and more of that bill is now being funded with debt. Credit default swaps, like the ones on Oracle, have been spiking for a while, and the latest announcements have only grown the skepticism. Yes, CDS markets are relatively illiquid, and small volumes can move contracts sharply, but it's still a signal you don't want to dismiss. All of this has weighed on prices, with firms like Google and others taking hits. But here's my view. I'm a firm believer that a bubble can't really form and then burst if everyone is already aware of it. That's why I don't think AI is a bubble, at least not yet. Real bubbles happen where no one, or only a few, are actually seeing it. They develop as a consensus around an idea, something that can't be wrong, and feels too good not to jump on. Heading into the end of 2025, every Twitter post, news article, and YouTube video was calling for AI to burst. But if everyone expects it, enough people are already hedging it, or even betting against it. For something to truly burst, people have to be caught off guard, not suspecting a thing. And that's why I think the real stock market bubble might be hiding in plain sight, and you are probably participating in it. Month after month, trillions of dollars pour into index funds and ETFs, and they have to buy stocks based purely on market cap weight, not fundamentals. In effect, these passive flows keep bidding up prices regardless of value. This is part of the reason the biggest companies keep getting bigger. In practice, when investors put money into an index fund, the biggest names get most of the new cash. That inflates valuations for the mega caps, while very little trickles down to smaller firms. Consider this. U.S. passive equity funds saw roughly $918 billion in net inflows last year, versus $177 billion flowing out of active funds. Even Wall Street admits there's a staggering $22.5 trillion in U.S. passive stock funds now. That's about half the entire stock market, meaning index investors are the dominant force right now. And all that money chasing the same handful of names has become a self-fulfilling feedback loop, turbocharging a narrow market rally. Over 50% of U.S. equity ownership is now via index funds and ETFs. America's largest 7 stocks, the Magnificent Seven, now make up roughly 1/3 of the S&P 500's value. And when you look at household balance sheets, around 32% of U.S. household wealth is effectively tied to equities, a very high exposure by historical standards. Research also shows passive inflows disproportionately raise the stock prices of the largest firms. Here's how it works. Imagine an S&P 500 index fund suddenly gets a $1 billion inflow. Under cap-weighted rules, about 8.3% goes to the largest stock, say Nvidia, roughly $83 million, while the tiniest stock, like News Corp, gets only $64,000. That increase then raises Nvidia's share of the index, so next time, even more of the new money goes there. The rich get richer by default. As one analysis puts it, millions of investors pour money into S&P 500 index funds. Those funds automatically buy stocks in proportion to their size, creating a feedback loop. The more these stocks go up, the larger their weight, and the more index funds must buy them. Over time, this passive flow of money has warped the market by boosting the same handful of stocks, simply because they are already big. And this is not random. As more money flows into index funds, the largest companies receive the lion's share of new capital. The numbers back it up. Academic studies confirm passive flows lift megacaps fastest, and can even help push the overall market higher on autopilot. Some research suggests that even if flows are simply reallocations from active to passive, the aggregate market can still rise. In plain terms, when index funds swell, winners win more, and the rest lag behind. Money has been flowing into index funds every month, lifting stocks on pure inertia. One study even notes that the largest stocks tend to outperform the index in the first week of each month, reflecting regular paycheck-driven investing into passive funds. Like clockwork, passive strategies are padding the champions at the expense of everyone else. It becomes a self-fulfilling momentum trade as long as the flows keep coming. With roughly 1/3 of U.S. household net worth tied to equities, the danger is obvious. When that allocation gets this high, history tends to wave a red flag. At minimum, it means a huge chunk of household balance sheets is now hostage to equity drawdowns, especially when so much of the market's upside has been driven by mechanical buying rather than fundamentals. And here's the scary part. The same index feedback loop that pumped prices up can reverse violently. A risk analysis warns that the exact same loop works in reverse. If enough money starts flowing out of passive funds, the giants that benefited most from automatic buying could get hit the hardest. The advice is to assume a 30% to 50% retracement at some point. What went up on autopilot can come down just as mechanically. Someone put it bluntly. Passive funds were sold as democratization, but have become the crowd. Now the passive masses can amplify bubbles instead of dampening them. When everyone owns the same mega-cap stocks, there's no one left to buy the dip. So what now? We're not predicting the exact day the music stops, but ignoring this passive bubble is like trusting an elephant on a tightrope. Eventually, the weight shifts, and when such a large share of household wealth is already riding on equities, the idea of cash on the sidelines can be a misleading comfort. The true dry powder is smaller than people think, relative to the market cap now being supported by passive flows. The real story behind today's high-flying market isn't just AI or memes. It's a structural flood of passive dollars that has warped valuations.